Is Loretta Mester right? I mean, do we have a credit issue, or are we just going to keep coasting like this?
Well, I think if we think back to the spring, we've never seen the Fed or other advanced economy central bank respond to a negative shock with that speed or that much force. Within 2 weeks after a pandemic had been declared, the Fed had cut rates to zero, started purchasing Treasury securities at a previously unimaginable clip, and it also pledged effectively to backstop the corporate credit market. So as a result of those actions, businesses, with few exceptions, could borrow whatever amount of liquidity they needed to cover short-term operating losses. So the core contention of the Carlyle report is that these Fed actions didn't really prevent or eliminate defaults so much as flatten the curve. Yes, the first wave of defaults is going to be 40% smaller than one might have expected in March or April, but in many cases, these defaults have simply been pushed further into the future.
In terms of the impact on the economy, what will that be? We are going to take longer to get through the process of creative destruction. We are going to have zombie companies hanging around for that much longer before they ultimately end up defaulting. And I'm curious as to your sense of what that means in the phase kind of after we get the vaccine, after we've the post-COVID phase. What does the economy and the global economy look like?
Well, in that initial phase, in terms of the policymakers' response, they really wanted to err on the side of doing too much. The normal moral hazard concerns that would have kept the Fed from intervening on that scale were not present here, because they decided that no business could reasonably have been expected to prepare for a pandemic. But over the next 2 years, the calculus is going to change. Policymakers are going to start to worry about zombies, because zombies, by having excess capacity, introduce disinflationary pressure that makes it harder to hit your inflation targets. It also means that the more productive firms can't raise prices, and it also depresses the economy-wide return on capital. So I think what we're going to see in 2021 with the vaccine is this shift in policymakers' focus and becoming more sensitized to doing too much. They're going to end the facilities. Rates are going to remain low. Make no mistake about that. I think QE is going to continue, but these emergency liquidity facilities, the backstops, they're going away.
So, Jason, who's going to be at risk for that? I mean, is that going to be the credit investor, and will they not have the kind of recovery rate that you might expect? Or is it going to be the equity investor that if these companies keep going back to the market, issuing equity, having a big stockpile of cash, is it the equity investor more on the hook?
Well, I think what's so fascinating about the market today is that there's a little bit of everything. We always think about credit markets in terms of cycles, but this market defies cyclical characterization. You do have businesses that are in distress. That's largely retail. It's largely energy. Those are industries that were facing structural headwinds entering the crisis. You have those businesses that are probably going to benefit from pent-up demand in experiences spending, travel, tourism, live events. So, investing in them, and from the creditor's perspective, could be a good bet. They're going to grow rapidly, perhaps at the end of 2021. But I do want to also mention there's fast-growing businesses today in technology, business services, healthcare. In those capital structures, you have the largest equity contributions we've ever seen. So on average in 2020, equity contributions averaging 50% of enterprise value. So, when the market value of the assets of those businesses could fall in half, and the creditors are still fully covered in terms of the face value of their liabilities. So I think answering that question first just requires appreciation for how for the dispersion in the market and how different these individual situations happen to be.
Jason, the Fed, other central banks have created an environment where credit has been a no-brainer. With the Fed at your back, you have been able to make serious money in this space. As the Fed departs the field, as other central banks depart the field, as you suggest they will, what does that mean for credit investors that have gone down the credit scale because they're searching for yield, because they're searching for a greater pickup, and because they know that these central banks have got their back? How quickly does this reverse, and what does it look like?
Well, I think it looks like just increased dispersion. We see dramatic dispersion in real economic outcomes in terms of performance across industries. But because of that central bank backstop, we haven't seen a commensurate dispersion in pricing. zombie businesses can issue liabilities at roughly comparable spreads to businesses that are doing very well on a going concern basis. So I think the first step in this process, once the market operates without a net and central banks pull back those liquidity facilities, is just much more dramatic cross-sectional dispersion in spreads, in pricing. And I think that that's going to be a market where it's going to be very attractive for those investors that are able to identify those credits that perhaps today are in some bit of trouble because of the rise in cases and social distancing, but over a 2 to 3 year horizon are going to make that up as the pent-up demand for travel, for tourism, for live events manifests itself with dramatic growth in revenues.
We just had a pie chart that showed sort of energy really dealing with the defaults much more than any other sector. As we move forward and we get this dispersion, it's a twofold question, like what sectors are going to be hit the hardest and what do those recovery rates actually look like?
Well, I think that we missed the distress cycle this year in terms of the on the whole. You had prices that fell from an average of 96 per 100 of par down to 76. And those prices recovered in 5 weeks, the magnitude that it took 5 months in 2009 to generate the same amount of recovery. So I think when we look forward, it was really only energy and retail, again, facing structural headwinds, that was not able to issue this liquidity to cover those near-term losses because investors recognized that there were more structural factors at play. I think going forward, it's going to be idiosyncratic. It's going to be industrial firms, in some cases, that simply accumulated too much debt relative to the enterprise value of the business. It's certainly going to be some of the structural changes in terms of consumers' preferences for digital services or consuming more content at home that could have an impact on some of the experiences sectors, some of the live events. So I think it's really going to differ quite a bit on a cross-sectional basis. I think that, again, instead of the wave of defaults in certain industries or wave of defaults concentrated in time, we're just going to see persistently elevated default rates, but they're idiosyncratic. Again, a company-specific phenomenon.
I've spoken to a lot of people on the origination side over the last few years, and they continue to tell me that they were surprised the stuff was going out the door with the covenants that they were going out the door with. What is recovery going to look like with those covenant lights?
Well, I think as we see today in retail and energy, you're looking at recovery rates that are all-time lows. You have senior loan recovery rates that have recoveries that look like they're high-yield bonds and high-yield bond recoveries in 25, 30 cents on the dollar. So I think that is a phenomena that we see that those, but again, I think it's important to differentiate between those businesses that are facing this structural headwind where there's really not the going concern value and it's just sort of, melting like an ice cube versus those businesses that are really going to have unsustainable capital structures. They are going to be put in restructuring, but there's actually real value there, perhaps after a resolution.